Okay, welcome back. We are on page 8. On the last thing, we finished doing IFRS rational entity impairment. This is the cost recovery impairment model. So, similar kinds of steps, but different variables. So, first, a recoverability test is completed, which compares the assets carrying value to the undiscounted future cash. Big difference from IFRS, who used the discounted cash flows, right? That means this, we're not present valuing it, we're just them up. So we're not taking into consideration time value of money. So if undiscounted cash flows are less than CV, or carrying value, we record the impairment. If they're greater, then our asset isn't overstated, so there's no it. However, the impairment loss is calculated differently. It's the difference between the asset's carrying value and the fair value, which they call the price that would be agreed upon in an arm's length transaction. So quoted market prices in active markets are the best way to determine the fair value, but other methods such as discounted present value can be used. Okay? No recovery of it under ASPE. Now remember, ASPE is the one that needs a trigger. IFRS, you review it routinely. So on page 9. We own a piece of equipment. Pens are getting in the way. Because of a change in how the asset's being used, so that's our little trigger event. Now, not all the questions say that, but generally, with ASPE, you wait for that. We're doing it for impairment. So the asset's carrying value is $600,000, cost accumulated depreciation. Future undiscounted net cash flows are $650,000, so no present value. And the asset's fair value is $525,000. Record any necessary impairment. So first we do the recoverability test. And we take undiscounted cash flows and we compare them to the carrying value. So our undiscounted net cash flows are $150,000 and our carrying value is $600,000. So is our asset overstated? No, it's not. So asset is not overstated, so no impairment. So number 2 would be calculate impairment, but we don't have any. And 3, the entry for impairment. And again, we don't have any. Okay, now, example 6 is the same asset as above, except for net cash flows are $580,000. So we're going to do the exact same thing, check for impairment. So first, remember this is ASPE, the recoverability test. And actually, maybe put it on pause, you guys. Try this, see if you can calculate it. You don't know how to calculate impairment yet. I mean, you can read it from the last page, but just do the recoverability test and then come back. Okay, we're going to compare undiscounted cash flows versus the carrying value. So our undiscounted cash flows are $580,000. Now, if it said present value, that's not undiscounted. Okay? Okay, so we compare it to the carrying value. Carrying value is still $600,000. Asset overstated? Yes. So yes, impairment. Asset overstated. Okay? So the second thing we're going to do is actually calculate impairment, and it's different than, just like this, it's different than IFRS. So if you look on the last page, you want the difference between CV and FV. Okay? So our carrying value we know is 600,000. And the FV is up here somewhere. Assets fair value is 525. Oh, you didn't see that. It's up here. Assets fair value is 525. So that means you take the difference, 75,000, and that's the impairment. So now we can do the entry. Debit loss on impairment, 75,000, and credit accumulated impairment loss for 75,000. Got an extra zero there. And what else can we use in real life? Equipment or accumulated depreciation. And then you're going to make a little note. No reversal in the future. Okay, so those are the two methods, IFRS and ASPEs. And they're tricky. I mean, you guys are lucky you've got open book, so you can look at your little formulas. But remember, in real life, you'll have to refer to your notes. CPA, you're kind of stuck and you have to know this stuff. So again, the more you can get in now, long term, the better. I realize we've got a week to one of your classes exams. The other guys have a little more time. So, you know, if you're cramming it, that's okay. Keep your notes and your test. Okay, let's look at derecognition of assets. So, this, you know, we've done some of this already. So this should seem familiar. This is where you remove assets from your books. So the transactions here are similar to the transactions we did when we sold revalued property, plant, and equipment in Chapter 10 and in earlier chapters and last year when we sold assets. This bold part, remember to update depreciation from the last year end to the date of sale. We record the derecognition. So update, do the entry. Then close the asset account. It's accumulated depreciation. Everybody forgets this one, so put a star beside that one. Record any cash received and recognize a gain or loss. Now, of course, in the case where an asset has been revalued, you have to close revaluation surplus OCI to retained earnings or AOCI to retained earnings, all depending on what you did. I'm not going to worry too much about this. In terms of CPA and where AOCI ends up, it's the balances you have left. At the end of the year when it's all done. Okay? So you can close it to AOCI. You can close it to retained earnings. Either way, it ends up in retained earnings because it's sold. Okay? Okay, let's go to the next page and do an example. Or at least do some of the theory. Okay, depreciation continues for PPE assets. Sorry, I need some water. As we talked about on the first page, I think, of Chapter 10, until they are classified as held for sale in other assets or derecognized. At the date of disposal, all accounts related to the retired assets are removed, and that is accumulated depreciation. And if you have accumulated impairment, you're going to have to close that too, and so on. Gains and losses from the disposal of plant assets are shown on the income statement in income before discontinued operations, unless it's part of a discontinued operation. And it'll tell you that. Now, for property, plant, and equipment donated to an organization outside the reporting entity, the donation is reported fair value with a gain or loss on disposal recognized. Okay? So you'd have donation expense at fair value, and that's where you'd be. Okay, let's do an example and we'll cover some of these. We'll read through it and then I've got to change the video. So December 31st, 2019, Marin Inc. owns a machine with a carrying amount or book value of $98,000. So remember, you guys, all these carrying value, book value are the same. The original cost and accumulated depreciation for the machine on this date are follows. Machine accumulated depreciation, they don't have anything like accumulated impairment. If they did, it would also be subtracted off the machine, and so on. Depreciation is calculated at $60,000 per year on a straight line basis. So that's our main information, and then we've got all our choices. Okay, I'm going to change the video, and then we will keep going.